where we're discussing matters of retirement benefits, the industry landscape, some of the policy proposals, and what can be done to formalize the vastly informal segment. And before this, my colleague Lois Wangwe was in studio with Mr. Ruto in Eldoret, who is a retiree, and he did mention a couple of things where I would like now to bring my guests on set to discuss onto this. I have Crescencia Ododa from NWEL, where she's the manager for business development. I have Francis Sang from Zimele Asset Managers, where he's the pensions administrator. And I have Angela Okinda, head of the Umbrella Fund at Zamara Group. Welcome to the show. Crescencia, if I could start with you, just reacting to what Mr. Ruto said. He sounded like he was a pretty organized, or should I say relatively organized gentleman, where he had a savings account, he had his SACCO, and of course he had been putting money in a pension scheme. Many wouldn't have this kind of opportunity, especially in the informal segment. What do you think should be done, at least to formalize the vastly informal sector?
One of the things that I think will really improve the life of retirees, especially those working in the informal sector, is information. As he's mentioned, one of the key things that have really helped him is the fact that he had pre-retirement trainings before, and he was able to know, he was able to anticipate what his expenses would be and at least plan well in advance for them. I think we need to spread this across. This is one of the things that I think the regulator is very key on. He's really key on spreading in retirement knowledge to the informal sector, whereby we are having, there's a push of getting into the informal sector to increase the expansion, at least to have a wider base getting into retirement forms.
Okay.
Yeah.
And you mentioned the regulator, and I think it's important I mentioned that we were to have the Retirement Benefits Authority on this panel, but eventually they didn't manage to show up. So we shall continue the conversation. Francis Sang, many employees out here who are in the informal economy don't even know of the existence of arrangements around personal pension schemes. Perhaps you could shed some light on this and why it is important to adopt one.
Yeah, it's thank you. It's important to adopt one because generally pension, the purpose of pension is to substitute one's income after retirement. And retirement, because somebody in the informal sector may say that it's my business, for example, a sole proprietor. But retirement comes in a number of ways. When you age, you grow tired, and you need to supplement for the income that you're generating when you had the energy to work. So the main thing to do is information, and then for the industry to come up with products based on the income characteristics of these people in the informal sector. Flexible products that will allow them to save at ease, not putting so much conditions that will make it difficult for them to save.
And speaking about the flexibility of packages, you would appreciate that some of the people in the informal segment, this month you have a job, next month you don't have a job.
Yes.
And there is typically the requirement of a monthly remittance. How does someone now navigate this kind of requirement?
Now that is a condition that is making it difficult for somebody with such an income stream to save. But there are schemes, IPPs, that have come up that do not have that risk of contributions in arrears, where you can contribute what you have when you have at your own convenience. Okay. Because what you've contributed is what is being invested by the scheme. Okay. And the only thing that is remaining is now information. The industry takes this information to these people and to make them understand the importance of pension and the main purpose of pension, unlike other saving schemes or investments that are there in the industry.
Okay.
Yes.
And just to get to Angela on the same matter of informal segment and how these people can be brought on board.
Yes.
The concept of umbrella funds is very uncommon to many, and they wouldn't really understand what that relates to and how they can tap into it. Just walk us through what this is and why it is important.
Okay, so an umbrella fund is one retirement fund where many participating employers join and save. And what an umbrella fund does is it takes away the complexity and the risks of managing a pension fund, but it also reduces the costs because of the economies of scale that come with saving in a retirement fund. But just to touch on the conversation on informal savings, I think from my perspective, the informal savings sector, the informal sector are actually quite organized. And you'll find that even an individual who doesn't have a daily wage or a daily job is still able to pay rent, is still able to pay school fees, is still able to feed their household. So they are typically quite well organized. And I think one of the challenges they face is easy access to a platform for saving that doesn't carry heavy transactional costs. And the way the transaction sector works is the lower the amount of money you're remitting, the higher the transaction cost. So pension administrators, fund managers, and people in the industry have to do more to ensure that they can take away that barrier, because for as long as people in the informal sector have a belief in the objective that you're trying to achieve, they generally try to find a way of saving, even though they might have more pressure on disposable income.
Okay.
The other thing I would say on making pensions more affordable is perhaps looking at digital pensions. Currently, we have initiatives in the market by players who are trying to make it easy using platforms like M-Pesa. You don't have to physically go to a bank to save. And I think that savings for informal sector players is now becoming easier, perhaps easier in 2020 than it was 2 or 3 years ago.
Okay. And just to look a little bit about the industry landscape, one of the key highlights of the RBA industry report that was put out at the end of December last year was that in terms of growth in assets under management, which essentially gives an indication, if I could say, of the size of the retirement benefits, was that we posted a particularly slow growth, because year on year it was about 8%. Earlier before that, in 2017, it was about 12%. The year before it was about 14%. And we're trying to make sense of why we had this particular slowdown in terms of growth. And some of the key factors which come into mind, of course, we know the stock market hasn't been doing so well. But what are some of the factors driving this slow growth? If I could start with you, Crescencia.
One thing that actually drives this is the returns. I trust, like, when you look at the reports for last year in terms of investment, last year was probably not very good in terms of returns. Most schemes very few schemes reported a double digit in terms of return. That could have occasioned a very slow growth in terms of the growth size. And then as well, the other thing is, I think still member awareness and penetration is still a key factor that plays in terms of growth as well. Mm-hmm. Yeah.
So you mean the member awareness is, we had a slowdown in terms of new members coming on board, or what?
There was actually, and then as well, we had many people leaving off employment as well, therefore exiting in the fund as well. This actually, it withdraws the fund size and shrinks the fund size as well.
Okay.
Yeah.
Francis, on the same issue of the slow growth witnessed last year, what would you say are the key factors around this?
The key factors is that we are still looking at the same schemes. There are no new schemes in the industry. Then we are still looking at what we call the formal sector currently. And then if you look at the formal sector and the current economic environment, or what has been prevailing from the near past to current, it's been a difficult time. Employers have been reducing their employees in order to manage their finances in terms of pay, and this reduces the number of people in pension. And then the growth of the informal sector has been slow and very minimal. The penetration has been so low, and that's why we are not experiencing growth at the moment, coupled with the low returns on the investment side.
All right.
Yes.
Angela, on the same issue of the slow growth we witnessed last year?
Mm-hmm. I think they've alluded to the tough economic period we had last year, and that's evidenced every day in the news. You see employers are retrenching, offering voluntary early retirement packages. So net on net, you'll see that the total number of people exiting and getting big payouts was larger than those who were joining. We must also say that pensions currently in Kenya outside the NSSF is voluntary. Yeah. And as such, in a difficult economic environment, an employer who might have wanted to start would probably have delayed it in the last 2 years because of difficult fiscal times. Mm-hmm. But just to make a comment on investment returns, I think over the last 5 to 10 years, schemes have generally been investing largely in the capital markets, and that's your treasury, bills and bonds, and your stock market. And about 10 to 15 years ago, it was very easy to say that you could get a return of 30% from the equity market. But right now, if you look at the last 5 years alone, that return is less than 5%. Mm-hmm. And when you look at what's been happening with the interest rates, because there's been actually quite a large change, that's also affected the valuation on the treasury bond market. So for the last 5 years, when you look at the investment returns from retirement funds, you'll notice that because by nature they're typically 70 to 80% invested in the capital markets. And the capital markets have had their challenges. He's talked about no new listings in the equity market. We've seen some delistings coming on as well. Then the environment has been very difficult for retirement fund managers to post what we call an alpha or an excess adjusted returns. So this, I think, is a good problem, because at the end of the day, when you look at the level of assets or contributions coming to the pension scheme, it's still quite high. And trustees are now looking for where they can put this money. Comes the conversation now on alternative assets.
Okay.
Yes.
And we'll be getting to that conversation around asset allocation diversification a little later on. But the key question here is, when someone is scouting for a pension scheme to get into, what are some of the key factors that they should look at, especially if they're just getting into the labor market and they want to try and organize themselves for the next 20 or so years? Crescencia, what are some of the key factors to look at?
This is as an individual or as an employer. One thing, if you're getting into as an individual, you need to look at flexibility, what works for you and all that. Therefore, you need to determine as well, what are you getting into? Is it a provident or a pension? So that it can determine what you're getting out at the end of the period when you reach retirement as well. Then the good thing is that the industry has a lot of different tools that you can get into, such that there's a lot of flexibility in terms of contribution. You don't have to do monthly. You don't have to do, it's normally as and when available. And then as well, you need to look as well in terms of asset allocation, where are assets being allocated and all that, what returns are coming out as well, what's your age as well, also plays a great factor. This as well helps you in determining where you're going to put your funds into.
Okay.
Yeah.
Sam?
Okay, I think apart from what my colleague has said, you look at the value addition, because there's the flexibility, there's the return. Then you look at the value addition. What else does this pension come with? Because players, I think, are becoming innovative in they're attaching some other elements on pension. Like you may find that you're contributing to a pension, but for the time you're contributing, it may act as an insurance, maybe a life insurance, and it covers you, which is also a value addition. And also the fact that some schemes have adapted that you can use your pension to access mortgage when you want to build a house. So those are the other things that you can look at, apart from the basics, the value addition, and also the flexibility and the return.
Okay.
Yes.
I'm just looking at something like property. Before you get into it, it's a bit prohibitive. And then as well, there are a lot of risks as well involved. Therefore, when you look at this is money that someone is retiring into, this is their ultimate safety net. How safe can you go? How far can you go when you want to play in the pool as well? Therefore, I think safety is the biggest issue. And then as well, it could be a bit restrictive in that there are not very many assets you can get into until as well keep the security intact.
Okay. She holds of the view that we don't have as many asset classes that we can invest into. I don't know whether you share the same view.
It's like you were reading my mind. I do think that we have diversity. And if you look at the last, let's say, 5 years, and you look at the pensions market, you'll notice the number of private equity funds that we now have in the market have increased. Before, we barely had 1 or 2. Currently, we have over 8 private equity funds in the market. We had a real estate investment trust launched. Okay, it had some challenges, but again, that's a step towards moving away from direct investment in property to a unitized investment. We had the ETFs that were launched, we have the derivatives market, and now we have a conversation around infrastructure. I think from my perspective, the 2 challenges facing investment in alternative assets, number 1 is we appreciate that the tenor or the service that an employee will serve is reducing. On average, an employee will work 7 to 8 jobs before they retire. And that means you have a board of trustees that is probably not looking at members who are going to be there for 20 to 30 years. And that limits their ability to invest in long-term investments, because those long-term investments require time for them to be able to offer an excess adjusted return above inflation. That would be the first challenge. The second one would be retirement fund trustees have easy access to information about the capital markets. And private sector players have also done a lot in that space. So trustees can easily understand what's happening with stocks, what's happening with bonds. They can easily go to the newspaper and check what's happening with the auction. And they can also easily explain to their members what's happening with these investments. But today, Julius, if you were to tell members you were investing in derivatives and you had futures and options and you tell them you earned a negative return, they wouldn't quite understand it. So a lot needs to be done to demystify these alternatives. They exist, but a lot needs to be done to demystify them more to boards of trustees and members, and also create channels or vehicles that make it easier for a retirement fund to invest. And one of the things to do, I'll give you an example. Right now there's an initiative by pension funds called KEPFIC. So it's the Kenya Pension Funds Investment Consortium, a consortium of about 20 to 30 pension funds that have come together to invest in infrastructure. Why are they doing that? Because they've realized that investing in infrastructure is complicated and it's very hard for you to negotiate concessionary terms if you are one pension fund. So if more can be done to ensure that these vehicles have perhaps more guarantees, less risk, easier exit terms and conditions, and their terms and conditions are easier for members and trustees to understand, then you might find that the take-up of these instruments will increase over time. Yeah.
All right.
Yeah, you're talking about why the uptake of other investment options are not being taken up. This is mainly, as I was explaining, mainly because of the information gap. And then as well, I think there's a call on asset managers to demystify these things when presenting on these options to the trustees so that they can at least have their buy-in and as well have investment vehicles that at least are actually will be able to meet the risk appetite of the trustees pertaining to different funds. This will at least assist in the growth. And then as well, I think generally everything new coming in has some sort of a curve that has to take form, and it will probably be a while before the information is absorbed and people have the buy-in. But then ultimately, I believe you're going to see at least a more diversified options portfolio. Yeah.
Sang?
Yes, I think the slow uptake in the alternative investments is based on information and also the risk in the uptake, because most fund managers will look at the risk vis-a-vis the return. And if there is an asset even that has been in the market that is offering more or less the same return and a lower risk component, they'll go for this asset. And that is why currently most people are running to the government and fixed deposits with banks. Yes.
Angela?
I think the additional thing I'll add is the structure of these alternative assets. We've seen vehicles coming to the market that don't offer favorable terms to institutional investors such as pension funds. And you might find some of these alternative assets, for instance, don't have exit terms that give an institutional investor comfort that at the end, after taking the risk, that at the end of a 5 or 7 year period, they'll be able to exit and actually actualize that return. So I think one of the barriers to the uptake is some of the structures of these alternative assets don't necessarily deal with all the concerns that a board of trustees would have, and if some work could go around restructuring them, as I said, introducing guarantees, ensuring that the risk being taken truly offers a reward that is above a risk-free asset, then you might find that it might make more sense at that point for a board of trustees to go for alternative assets.
Okay. And speaking about the exit opportunities, I think one of the key issues I'd like us to focus on is the policy environment. And if you read Budget 2019-2020, there was a lot of proposal around the aspect of retirement benefit schemes. And I want to read just verbatim what the then Cabinet Secretary Henry Rotich said. The retirement benefit scheme, which invests in guaranteed funds, of course, which is one of the options you have, is subjected to unfavorable terms of exit. The schemes are required to withdraw funds in installments spread over 3 years. Otherwise, they suffer a charge of up to 25% of the fund value. You can imagine that. So I propose to amend the Retirement Benefits Act to reduce the period of transfer to 1 year. And if you follow with the finance bill which was tabled, this is actually one of the things which Parliament views should be maintained. What are your thoughts around this particular proposal, if I could start with Sang?
I think it's in good. It's good reducing it to a year, but also if you look at the flip side, it makes it difficult for, depending on the nature of investments that the scheme has invested in. Because imagine if you're exiting and the investment is like a long-term treasury bond, the component. How will you break it? How fast will the fund manager find a seller, a buyer for this item for you to, in order to allow you to exit? And also the complexity also comes in when it's invested, like it's an investment in an umbrella fund, where there are many schemes under an umbrella. So you know the investments, it's like they're like in a basket, and the funds are invested in proportions. So breaking such, that's why in the past they needed time, like 3 years, to break it while you are leaving. So it makes it advantageous to the scheme, but it makes it difficult to the fund manager.
Of asset allocation and options outside there. Angela, if I could get your views around this subject, what do you think is the way forward in terms of the policy proposals which have been made? I think you already shared some thoughts on this.
Well, I think that because Kenya is an entrepreneurial economy, there's a lot of scope for the NSE to expand. I think we've talked about it. When you look at the number of new listings coming up at the NSE, it's not quite reflective of our economy. So we think that there's a lot of scope there for entrepreneurs or other new listings to come to give an opportunity for further investment. The other thing that could happen on an asset allocation perspective is, we believe, more roundtables. We've talked about barriers to alternative assets between board of trustees, but if these parties, those providing the product and those consuming the product, could engage at an earlier stage, then it would mean that whatever comes out and is brought to the market has a higher chance of being absorbed, because all the consumer needs have already been dealt with. And as always, information, communication, and education.
Okay. I want to mention something else which was made in the budget 2019-2020 around retirement schemes, and this is what the budget said. I propose to amend the umbrella retirement benefit schemes regulations to allow members to contribute towards post-retirement medical funds, which I'd imagine was a plus in terms of value add from the retirement benefits standpoint. I don't know what your thoughts were, especially in terms of how this will be structured within respective funds. If I could start with Sam.
Yeah, I think it's a value addition, and it's good that it can be structured, and if communicated well, if the information is passed well to the public, it will also increase the uptake into the schemes. The only thing that I think should be done, make it affordable. Okay. Because I think products should be driven by the market. So we should look at the market and design products that will fit into this market. Make it affordable, make the entry level affordable to the normal Kenyan entrepreneur, somebody who's working and generating an income. Then it will be good to go. The pension uptake will increase because it's an advantage for an individual. Okay. If you ask me to invest in a pension scheme and one that offers me a medical, post-retirement medical cover, then I'll go to the one that has the rider.
Okay.
Yes.
And Crescencia is still on the same. He's talking about affordability, and I'd imagine why this proposal came forth in the budget is many retirees will tell you that their pension went into offsetting medical bills. How best, in terms of affordability, can this be made in terms of just ensuring it reaches to those whom it seeks to help most, and that's at the bottom of the pyramid?
Actually, even before I start on that, I think this was something that the market was really looking up to, because the need was already there. There'd been that gap for a while, and as you've mentioned, most retirees have a larger percentage of their expenses going into medical expenses. How affordable can it get? I think the one thing we need to consider, because the more you save and the sooner you start saving, the more affordable it will be later on for you. Therefore, I think it will be advisable that this product is actually launched at a very early age. We keep encouraging that pension, anything to do with pension should start actually at the onset once you get into employment, so that you can at least see what expenses do I expect to incur later on, and what am I doing about it right now, so that at least they can be able to take care of that in the future. Medical expenses at old age are generally quite high.
Sure.
And one way you can actually leverage on that is, at least as soon as you start, immediately you start on your pension as well, just start on your medical as well, so that at least it can increase. One thing we keep encouraging, I'm glad that at NWealth we have a product, Anaya Post-Retirement Medical Care, which at least it's actually a rider on the umbrella. For every employer coming on board, we keep as well encouraging so that people can as well do this even at a voluntary level over and above whatever is being contributed. Therefore, the sooner you begin, that's the trick.
Okay.
It will at least safeguard you in the future. Yeah.
Angela?
Well, I think it's a fantastic initiative, and it's good that it's now been legislated, so it's not a gray area. I think the issue of medical cover, in the last 5 years alone, I think the cost of medical cover has risen by over 30%. And at Zamara, we have an insurance broking team who do a lot of work around medical insurance. And one of the things we've seen is that when you look at the type of illnesses that people are suffering from, you've seen an increase in things like lifestyle diseases. Now, usually in the pricing of a medical cover, they would look at a population and kind of give you a premium that covers everyone. But we're starting to see covers being designed where they will have a particular rider that deals with chronic illnesses, a particular rider that deals with lifestyle diseases like hypertension. And that way, when you give a person like a cafeteria of options on medical insurance, it then means that they can take the option that suits them the most. On our end at Zamara, we also have an umbrella medical fund called Ngao Milele. And I think the best thing about Ngao Milele is it allows you to save over your 20, 30 years, and you can say, okay, let me put my 10% into pension, let me add another 5 for medical insurance. But also, at the end of that period, you have a choice as to what type of cover you'll take, which provider you will use, because definitely someone who's looking at retirement in 20 years will not necessarily have an idea of what the environment or the illnesses will look at that period. Yeah. So I think it's a fantastic initiative, and members need to be encouraged more to save for it.
Okay.
Yeah.
And the question always becomes that for this kind of proposal, for example, in the event that now it's taken up at the market as products as such, if, say, just 1 year to retirement and there is a post-retirement medical fund, will I be viable for entry into it? Because I'm just at the tail end of my retirement savings. I'm supposed now to start drawing from that kitty. How do you see this working? Because that's an area that has raised a lot of uncertainty. I don't know what you think about it.
To mention on that, being a new product in the industry, and we're having retirees at the moment, meaning it's something that they didn't have the advantage of starting early, and it's still, the good thing is that they're not cut out. They can still look into it. One way to do it, for example, if you're going to earn a pension, you can actually have some sort of premium. The good thing is as well, the market is allowing you where you can do monthly contribution towards it. In our income drawdown at Annual, we have whereby we have an understanding whereby you can have part of your drawdown fund going into your medical fund, whereby you can be able to accumulate a particular into it so that it goes into a premium, and then the rest of it is paid out to you as a pension. Therefore, you can still enjoy the benefit of being into a enjoying medical cover even at retirement, although having started a bit late.
Okay.
Yeah.
So, sure, please.
I can add something. The current legislation on post-retirement medical actually allows a member to transfer up to 10% of what is sitting in their retirement account into a post-retirement medical account for purposes of medical insurance. So a member might not have had the benefit of a 10-year period to save, but even as we speak today, as long as you have a retirement benefit and your scheme rules have been amended to provide for it, you can transfer into a post-retirement medical fund and be able to cater for your PRM through that type of vehicle.
Okay. Sam?
Yes, and that is true, but also I think it depends on what amount have you saved. If you are just about to retire and you want to get into such a scheme, that's why people are encouraged to start saving early and to put in plausible amounts that will enable you generate good income when you retire. Because if your amount is trivial or something that cannot subjected into an income plan, it will be very difficult for you to get into a medical plan post-retirement. But for people who have saved significant amounts, then it's possible, either through a drawdown, as my colleague has said, where you can structure part of the payment to go to the medical plan, and you are covered for the period of time that the income plan is running into.
Okay.
Yes.
And as we get to the tail end of the conversation, oftentimes we get this view from retirees that they're shocked at the amounts they're given at the end of the day when they retire, especially in the public service. And the argument has always been, but you've been putting in 200 shillings in the NSSF statutory amount. And the debate now is, should we revise this amount upwards or not? Because finally, when you get to the tail end, many of us over the years never appreciate just how small a fraction 200 is of your monthly income, for example. Is this a view the panel shares, that perhaps it's time we revised it upwards, or what are your thoughts around it? If I could start with Angela.
Okay. Just to take your question, I always tell members that, you know, retirement is a personal thing. And I think that a lot has been done at the government level to introduce the new NSSF Act in 2013, which is yet to be implemented, to raise the minimum rates of saving. But absent of legislation, at the end of the day, retirement is a very personal thing, and a company is not going to close its doors because you're retired. So whether legislation permits it or not, an individual has to look at their own personal goals and start. At Zamara, we usually start with the end. And what we usually do is calculate something called a net replacement ratio, which gives a member an indication of the rate at which they're able to replace their income in retirement with their current level of savings. And just to give you some statistics, by and large, an individual should save at least 15% over a 30-year period consistently to afford a net replacement ratio of about 66%. And that means that if you're starting at less than 30 years, then you need to be saving more to afford the same level of savings. Yeah. So my view on that is that a member's expectation should be guided by statistics. And if you want to get to your destination, you have to sit down and take the time and ask yourself, what will a decent retirement benefit be? And then work backwards and ask yourself, what should I be putting in today to ensure that I get to that retirement target or that retirement goal that I want to achieve.
Okay. And Sang, I mean, Angela mentioned that retirement is a very personal thing, but we all know that while this is not statutory, perhaps there are those who would never even be remitting towards it. I mean, this is Kenya, to be honest. What are your thoughts around this as we close this show?
Yeah, I believe retirement is personal, but also apart from making it compulsory and coming up with laws to force people, as I say, to save for retirement, there should be persuasion. And the persuasion, because it's basically on an individual basis, because for a company that has an occupational scheme, it sees it as a cost, like contributing something above what the employee is contributing. And I think the problem with our country, we've not, savings is not a culture. And we should go back to the roots, like from school, where people encouraged students as they grow up on saving for retirement, and they have the information. Because, for example, I'll tell you personally, I knew about pension after I cleared campus.
Okay.
And that makes it difficult, because when you tell me about it, before you take me through the reasoning that you're keeping my money and I'm supposed to have it and use it in some other things, before the understanding, it's too late. So we should put it as a culture, persuade people, put it in the syllabus, let people know about pension and the importance of pension.
I see.
And then people will just save.
Quite sincere?
And Julius, what you've mentioned brings to memory, there's a research that NWAL carried out with collaboration with Strathmore, just how well prepared are Kenyans for retirement. And it shows just 1 out of 7 actually say they'll be comfortable in retirement and will probably outlive their retirement savings. This is shocking, because actually, and then as well, what's the income replacement ratio at the moment? We're having it at around 55, which is still way below what people are currently surviving on. And we know the expenses will increase. As my colleagues have mentioned, pension is such a personal matter. And one thing I always encourage people, I keep telling them that the young you is what will take care of the old you. Therefore, you have to start now, because, and then as well, we're seeing a higher life expectancy, whereby probably you work for, let's say, 20 to 30 years, probably at most, but then thereafter, I've seen a retiree who retired in 1987, still alive and very well, very fit. What does that mean? He probably has many more years to survive. Okay. And whatever pension is offering is still very little, making them looking for other alternatives to probably survive. You know, you have to get into other measures. Yes.
All right.